Welcome to another video. Today's video is about lending criteria. A couple of lenders have changed their lending criteria, and as always, I'm here to show you what that new lending criteria is so you are up to date with everything mortgages. So this is an update I received from Accord Mortgages, who are part of Yorkshire Building Society. So this is for residential applications only, and it's for part interest only and part repayment. So yes, you heard it correctly. Not always does a mortgage need to be on full capital repayment basis. There are certain lending criteria applicable to qualify for a part and part mortgage application, but on basis, what Accord are saying here is their part and part lending has changed for anyone who's using a repayment vehicle as sale of property. So when you're taking an interest only mortgage out, you need to give the lender a repayment vehicle for the interest only element, because interest only is interest only, which means the mortgage balance will never reduce. So at some point, that loan amount will need to get repaid back to the lender at the end of the term, and they want to know how you're going to pay that back. So if your repayment strategy is sale of property, what Accord are saying now is they're changing the equity requirement from the time of application to the end of the mortgage term. So previously, Accord needed 300k equity at the start of the mortgage to be able to qualify for this part interest only part repayment mortgage. Now what they're saying is you only need to have 300k equity at the end of the mortgage term to qualify for this part and part interest only product. Now Accord are a very good lender in terms of providing income multiples of 5 and even 5.5 times for certain applicants. The majority of people do take a capital repayment mortgage, but this type of mortgage can work in certain scenarios. So make sure you speak to a broker or speak to the bank directly to find out if this is an actual suitable option for you. So what they're saying is this is not available for buy-to-let lending. It's only for residential properties. The property must have a minimum equity of £250,000 at the end of the mortgage term and £300,000 if the security property is in London. The total borrowing remains up to a maximum 85% loan to value for part and part loans. A maximum of 75% can be on interest only with another acceptable repayment strategy. All other affordability policy rules, scorecard requirements must be. Now, the next lending criteria, you're going to love this. For anyone who's self-employed, Aldermore Bank have now said that they've increased their loan to value for self-employed applicants who've got less than 2 years trading to 90%. So previously, their maximum loan to value for this type of mortgage was 85%, but now they're saying if you've got less than 2 years trading, they've increased it to 90% loan to value, meaning you only need a 10% deposit for a mortgage. And another thing, what they've said here is customers with 1 year's accounting information will be considered, but will also require their latest 3 months business and personal bank statement. That's pretty game changing, because the majority of high street lenders want at least 2 years trading with 2 years tax returns or 2 years company accounts to consider any self-employed persons for a mortgage. Now, what Aldermore Bank are saying here is they can definitely consider someone with 1 year's accounts up to 90% loan to value. The latest 3 months bank statements are needed because they want to see sustainability in the business. So for example, if you're showing an income of £50,000, salary and dividends, assume you're a limited company director, and your latest 3 months bank statements show £2,000 coming in. Technically, the latest 3 months bank statements don't support the £50,000 you're using for the mortgage application. So it's very unlikely that a lender is going to approve your mortgage based on your latest 3 months bank statements. What they want to see is a regular income coming in every single month, not just Aldermore, but any bank for self-employed people. They want to see regular income coming in every single month to show that the income used for your mortgage application is sustainable going forwards, and most likely will be the same, if not higher, the next year. Because at the end of the day, lenders are using your income to give you a mortgage. So you're basically telling the lender, if you've got 1 year's accounts, you've got no previous track record, that you are going to hit that income that you've hit this year. And the only real way for lenders to know this is either looking at your latest 3 months bank statements, and a lot of lenders may require a projection from an accountant if you have one. Today is the 14th of March 2024 at time of recording, and these are the up-to-date lending criteria changes. Remember, lenders change their criteria all the time, so what I'm telling you today may be slightly different in the future. If you want to be kept up to date with all things mortgage lending criteria to ensure that when it's your time to go on the property ladder, that you know the lender's criteria, and if anything has changed, please do subscribe to this channel.